as well. Okay, so let me grab my pen. So chapter 3 has a few different parts that I break it down in. Today is going to be focused on learning objective 1 because a lot of it is analysis. Okay, and if you can analyze business transactions and how they're affecting the accounts, all this other stuff is going to make a lot more sense. So I tend to spend a day on learning objective 1 and ask you to please take it seriously and spend some time understanding the analysis. Okay. After that, we'll actually be doing accounting. Woohoo! Learning how accounts have two sides, learning how to put once you analyze things and you understand how the accounts are affected, the first accounting record you're going to be learning is about the accounting journal. It's extremely important. Everything starts in the journal. This is actually where accounting starts in terms of its written form. Then you're going to learn about something called a general ledger. Anything that goes into the journal gets transferred over to the ledger. The ledger is where all the balances are. So if a company wants to know the balance in any account, it would be in the ledger. The ledger is updated constantly, and we make sure the ledger is balanced by doing that very last thing called a trial balance. So this is what you're going to be learning in chapter 3. Chapter 3 is its own learning module, the way I have it set up in this course, because there's a lot of work to do here. Okay, it's relatively time-consuming work, and it continues in chapter 4. And this is just the really beginning of the bookkeeping cycle. Chapter 4 closes it out. Okay, so it's important that you do well in this particular one. So learning objective 1 is the focus today. It is about analyzing something called a business transaction and how it affects the accounts. Okay, so accounting basically needs to collect and process data regarding those transactions. And then that data is organized and communicated into financial information for decision makers of the company, as you'll see, because you'll be doing it. You'll be doing it. Chapter 3 covers the first 4 parts of this process. Okay. Emphasis on analyzing the transactions. If you analyze things well, all this other stuff works out. All the remaining ones that you see here are chapter 4. So the adjusting entries, all this other stuff at the bottom here, we're going to be finishing in chapter 4. Okay. The good news for folks that are interested in getting into accounting is, of course, these systems are all computerized and work quite well at this point. But back in the day, as they all say, everything was done by hand. And so everything had to be written down and organized. As you can see, it was quite a lot of work. Okay, it all starts with the first key term for you. Transactions. What is a transaction? A transaction is an economic event that happened to the company, okay, that has a financial impact on the company. Not everything the company does is a transaction, because not everything the company does actually has a financial impact on them. So you might have someone walk into your store, ask some questions about your products or services. You might give them a few brochures for them to think about, and they leave the store. Well, nothing financial happened there, okay? So that's not a transaction. It's not a transaction because nothing financial happened at the time that the customer or the potential customer walked in and walked out. Okay, it's not an economic event. An economic event would be if that customer came in, you were talking with the customer about your products and services, and then they put an order in. They wanted to buy something and they put a payment. That's a transaction, because now what you have is an economic event, okay? The customer has ordered a product, put payment down for a product. You have to deliver this product. You just got a payment from a customer. So this is an economic event that affects the financial condition of the company. And so anything that affects the financial condition of the company at the time it's happening is a transaction, is an economic event, is something that's going to be required to do accounting. We only record economic events at the time that they happen. And this really kind of screws people up in different ways, because so many people are looking in the future and saying, well, yes, if we have a customer soon, that's an economic event. No, it's not. Let's take another weird way. I mean, because businesses need to hire labor, right? When you went for a job interview and you were told, congratulations, you've got the job. I'm going to start you at $15 an hour and you'll start on next Monday. Well, that sounds like a financial transaction when in fact it's not, because they don't pay you up front. You have to work first, put in a pay card or slip, and then they pay you, right? So it's a financial transaction at the time it impacts the business financially. When I hire someone, regardless how much I promise to pay them, I could promise to pay them $1 million, but I haven't paid them yet. So it's not a transaction until it happens, okay? And I think that's what a lot of people get confused. They look too far ahead. They look way too far ahead. When in accounting, we're looking at the now. We're looking at things right now. Did anything change financially right now? If the answer is yes, it's a transaction. If the answer is no, it's not a transaction. Okay, so when it says not all the activities are transactions, that's what you have to think about. Did this activity financially affect the company as it was happening? If it affected the company as it was happening, it's a transaction. Okay. If there was no financial change as it's happening, not a transaction. You're going to learn that these transactions are going to affect the accounts. Excuse me. And as you already know, accounts basically are going to be fall in the line of asset accounts, liability accounts. And what we're going to learn in this chapter is the extended or expanded way of looking at stockholders' equity. And that's going to be something you need to know as well. That's going to be very, very important. And the last thing you need to know about transactions is they have a dual effect on the accounting equation, meaning that at least two accounts are affected by every transaction. Okay, so if there's an economic event, which is a transaction, then you can be sure that at least two different accounts are going to change. Okay, never is it just one account. So a customer comes in and pays cash for a product that you sell to them. Well, it's not, you say, okay, I got a bunch of cash, so my cash is changed and that's it. Well, no, you also made a sale. So your sales revenue is also changed. So you have more sales revenue and you have more cash through that transaction. And this is the analysis that has to be done in this part of the chapter for you to understand the rest of it. If you kind of understand the analysis piece, the rest of it's going to make perfect sense. Okay. But one of the most important stops you have in learning is a transaction. What's a transaction? Not everything that happens is a transaction, because not everything that happens in a business is an economic event. It has to happen at the time it's happening. It's not a promise for something in the future to happen. We do accounting based on what happens now, not what will happen in the future. Accounting is done in the now, okay? It changes assets, liabilities, or stockholders' equity. You're going to learn about the expanded way of looking at stockholders' equity in a moment. And you can be sure that every single economic event, every single transaction affects at least 2 different accounts. So like I mentioned, if a customer comes in and puts cash down and takes a product because we sold a product to them, cash is affected and sales revenue is affected, because what happened is we sold the customer a product and they gave us cash. So cash and those 2 accounts are affected by that particular transaction. That's what you're going to need to learn in this chapter. So, are the following events transactions? Well, let's look at the first event, okay? The first event is we purchased a computer. So if you are a business and you purchased a computer, which in this case we're going to be calling equipment, okay? Well, is that an economic transaction? At the time you purchased a computer, did the financial position of the company change? Yes, yes. If you purchased that computer with cash, 2 accounts were affected by that. You have more equipment because you just bought a computer, but now you have less cash because you used cash to purchase the computer. Those 2 accounts would be affected. What if you purchased that computer on account, which means that the business who you bought the computer from gave you an invoice and said, yeah, pay me later, pay me within the month. You can take the computer and here's a bill. Yeah. Well, yes, that's also a transaction because you just received a computer. You have more equipment, right? You have more of that particular asset. But now you have a bill to pay, right? So now you have more accounts payable. So again, 2 accounts are affected by every single transaction, okay? So purchasing computer equipment would require us to do accounting because we know that that is an event that changed the financial condition of the company, okay? Again, if we bought the computer with cash, 2 different asset accounts were affected, okay? More equipment, but less cash. If we bought that computer on account, meaning we got an invoice to pay, we know that assets and liabilities were affected. We have more equipment. Equipment is an asset account. But now we have more accounts payable. We have another bill to pay this month because we bought that computer. And so now we have more accounts payable. So again, 2 specific accounts are affected by the transaction. That's the dual effect in action. So if it affects the financial condition of the company, yes, we are doing accounting, okay? Because it's a transaction. Remember, transactions are economic events that change the financial condition of the company when it happens. The second event that's listed here is we simply discuss guided trip options with the customer. And it doesn't matter that we gave them brochures. It doesn't matter that we even gave them a quote to think about, right? Some people need to have, well, get me a quote, on what this is going to cost me. That's a reasonable thing for businesses to do. Even if I wrote them a quote and I gave it to them, that's not a transaction. It's just simply a quote, right? Because they didn't buy anything from me. They didn't give me any money. I didn't sell them any products. All I did is give them a number on a piece of paper in case they were interested in the future. Even if I discuss things and try to sell a trip, in case this is for Sierra Corporation, right? If I try to sell them a hiking tour, and they say, well, thanks, it was very interesting talking with you. There was nothing that changed. It's not a transaction because it's not an economic event. They didn't put any money down. I didn't sell anything to them. All I did was talk to them about what we do, what type of trips and how beautiful they are. I might even show them some photos. I might even be giving them some photos. Nothing changed. Giving someone a brochure is not a financial transaction, not an economic event. Talking to clients is not. So only when things change. So that's why this says no. This is not a transaction. This does not require the company to do any accounting because the economic or the financial condition of the company has not changed from talking to customers. But things might be totally different. I might be, discussing with a customer and they say, okay, yeah, I want to go on a trip. Your next tour is leaving at 9:30. I want to be on the next bus, or I want to be on the next hike, rather. And so they put money down and they buy a ticket for the tour. Well, that's a transaction because now financial condition has changed. I just sold a tour and they just gave me cash. So it has to affect the financial condition of the company as it's happening to require you to do accounting. That's something you're going to have to learn. You can't be projecting in the future, well, it'll happen. We don't care. We'll do the accounting when it happens in the future. We'll get to that bridge when we cross it. We only do accounting for what's happening right now. Okay. The last event shows what happens when the company pays rent. Is that an economic event? In other words, is that a transaction? Yes, it is definitely a transaction. It's definitely a transaction. And at least two accounts are affected when the company pays rent. Okay, now I don't know about you, but when you pay rent to a landlord, they want, they want money. They want real cash, right? So you're going to have less cash when you pay rent. Because anytime you pay a bill, your rent, your salaries and wages, you have utilities to pay. Every time you pay a bill, you're paying it in cash because people don't want anything else. They want cash. And so you're going to have less cash when you pay rent. But what is rent? If I'm a business and I pay rent, how do I show that? Well, that's a rent expense. Right? It's a cost of doing business is a rent expense. So if I pay rent, I'm going to have a rent expense, which is an account, and I'm also going to have less cash. A cash is also an account. So at least two accounts are affected when, in this case, I pay rent. This is the type of mindset you have to be in for this chapter in accounting when you analyze these things. Okay, this is a good little this is good to look at. That's on the top of page 93 to look at this. Okay, so again, transactions are economic events that change accounts. At least two different accounts are changed. And so if they are changed, that means we could have more or less in an account, right? And so when we pay our rent, we have less cash because we have to take cash out of the company to pay that rent, right? But we have more expenses. When we bought a computer for cash, we had more computer equipment, but we had less cash. So in other words, every time a transaction or event happens, at least two accounts are going to change. And that means that it's quite possible that your basic accounting equation is going to change with it. But it always has to balance. Your assets always have to equal liabilities and stockholders' equity. They always, always, always have to equal them. We're going to take a quick deep dive into expanding the idea of stockholders' equity and looking at these transactions from a broader perspective. So let's pay attention to how stockholders' equity is broken down. Stockholders' equity, we know, have two main accounts, right? Common stock, when the owners put the initial investment in the company, they get shares of stock, common stock. And then after the company operates for a while, they will understand whether they actually have any retained earnings, right? So we know common stock has those two main accounts. But let's really deep dive into retained earnings. Retained earnings statement, as you know from chapter 1, is the beginning retained earnings plus net income minus dividends gives you ending retained earnings. And that ending retained earnings balance gets put on the balance sheet. So really what retained earnings is the actual income statement, right? The income statement is revenues minus expenses. So the income statement really kind of closes itself into retained earnings. The income statement gives us net income, right? Revenue minus expenses, we're hoping for net income. And then we take that net income and we subtract out our dividends. So the retained earnings statement is net income minus dividends. All of these statements fold into retained earnings. The income statement, again, revenue minus expenses. That's on the income statement. Revenue minus expenses give us net income. Net income minus dividends is the retained earnings statement. Remember, the balance of the retained earnings statement goes in retained earnings. Retained earnings is the stockholder's equity account. So the income statement folds into the retained earnings statement, which folds into retained earnings. Okay. So in other words, even though this is the income statement, which is very important, and this is the retained earnings statement, the numbers eventually flow into the balance sheet. Okay. The numbers are going to eventually be in retained earnings. So whenever we get revenue, revenue is the source of our profit. Revenue is the source of our profit. And so revenues basically increase retained earnings because revenue covers all the expenses and what's left is our profit, our earnings, right, our net income. Expenses obviously take away from retained earnings because they take away from that revenue. We use the revenue to cover our expenses, yes. So in essence, all expenses take away from retained earnings in the big picture because they take away from the profit. Right? The more expenses you have, the less profit you have. So expenses take away from the profits of the company. And then of course, you know, on the retained earnings statement, we take the net income, which is our revenue minus expenses. Right? That's the product of those. I'm sorry, the sum of those. Right? And we subtract out the dividends, right? Because dividends are going out of the company. Dividends are not going to be retained. And so net income minus dividends gives us retained earnings. Dividends basically take away from retained earnings. Expenses take away from retained earnings, right? Because they take away from the profit. Revenue is where our profits are. So revenues are going to add to our profits. More revenues mean likely more retained earnings. Because more revenue would likely mean more profits for us. Okay, that's a very important aspect to understand here. Okay, so your book has a series of transactions on Sierra Corporation, beginning on page 94 and going all the way through page 99. And you need to know these, in essence, because you need to understand what happened. The purpose of this is to understand the analysis of what just happened. So check this out. You have an event that's listed here, but they've given you the assets equals liabilities and stockholders' equity accounts. Notice how stockholders' equity, the retained earnings is expanded, right? Because you have your income statement here, accounts, and the retained earnings account is together, right? Net income, which is the result of revenue minus expenses minus dividends. So you have to look at stockholders' equity and particularly retained earnings as in a broad way, okay, in a broader way. So look what happened on October the 1st. $10,000 of cash is invested in exchange for 10,000 of common stock. That's a transaction because the financial condition of the company has changed. How has it changed? Well, the company just got a whole mess of cash. So as you see here under the assets, since cash is the first asset account, what this shows us is we actually have more cash. This is not accounting, this is analysis. Okay, this is not how accounting is actually done. You're going to learn that in our next class. This is simply the analysis. $10,000 more in cash. How did the company get $10,000 more in cash? Well, because the owners now have $10,000 more of common stock. Common stock is a stockholders' equity account, and now there are more common stockholders by 10,000. So in event number 1, this transaction affected 2 accounts. It affected cash and it affected common stock. How did it affect it? Well, the company has more cash. So the plus 10,000 here simply indicates from an analysis perspective. This is not accounting, this is simply analysis. The company has $10,000 more in cash. It also has $10,000 more in common stock. Okay. And if you have questions as we go, you have 2 ways to reach me, right? You have that chat feature. You also can take yourself off of mute and politely interrupt and ask a question. This is on page 94. Now we're going to the bottom of 94 into 95. Event number 2. Event number 2 also happens on the same date, October the 1st. Sierra Corporation, they borrowed $5,000 from Castle Bank by signing a 3-month, 12%, $5,000 note payable. So how this works, when a corporation gets a loan from a bank, the corporation gets the cash, and they get approved, obviously. The corporation gets the cash because they're granted the loan. So they got $5,000 loan, they get the $5,000 cash. But so you see here that the company has $5,000 more in cash because they just borrowed $5,000 cash from the bank. But if you also notice under liabilities, the company also has more debt, right? They have $5,000 more of notes payable to pay. So those 2 accounts are affected by this transaction, okay? More cash, more debt to pay in the form of a note payable, okay? All right. And again, the nice thing about the book here is when they set up the accounting equation, they actually give you the accounts up front. So it helps you understand of all the accounts that are listed here, which 2 were affected. Now remember how notes payable work. It doesn't matter that they are charged interest. They're not paying it until the very end of the 3-month period. That's how notes work, right? Notes payable are paid on the maturity date. Everything is paid all at once. Now I know I am coughing here, cutting grass. Okay, I have bad allergy. All right, so event number 3 happened on the next day. And that's what you'll also see is that transactions are recorded in the order in which they happen. So now we're on October the 2nd. Sierra Corporation purchased equipment by paying cash to Superior Equipment Sales. So this is a transaction because the financial condition of the company has changed. They have $5,000 more of equipment, but they had to use cash to buy that equipment, so they have $5,000 less in cash. Okay, and again, what we're doing here is analyzing. This is not accounting. We're going to get to accounting on Wednesday or next class. This is just analysis. But if you don't know how to do the analysis, you're not going to know how to do the rest of it. So you need to put the work in here. Event number 4 also happened on the 2nd of October. And look what happened here. Sierra Corporation received $1,200 cash advance from a client, our Knox. They just got $1,200 handed to them from a client. They owe the client, right? Clients don't just give money and expect nothing in return, right? So if you have a customer and they paid you, they're expecting the product or the service to be delivered. Excuse me. So what just happened here? Well, 2 accounts are affected. One is the company has $1,200 more in cash because the customer just plopped down $1,200 in cash to them. But the client is looking at this as a cash advance. In other words, they're paying up front. So the company now has a liability, unearned service revenue. They owe the client $1,200 of tours for whatever this client paid for, right? And in this case, Sierra Corporation only does tours, and so obviously this client is expecting $1,200 of tours in the future. Again, cash is affected, unearned service revenue is affected. Those 2 accounts are affected by this transaction. The next event happened on the next day, October the 3rd. And Sierra Corporation got $10,000 in cash from another company, Copa Company, for guided services performed. And I want you to know this word. Whenever you see the word performed, it means the work has been done. So in this case, guided services performed means they've already given the tours. If they've already given the tours, they've earned the money. If they've earned the money, it's revenue, service revenue. Okay. So 2 things happened here. One is the company earned $10,000 worth of revenue. Remember, revenue is where the profit is. So it basically is an increase to retained earnings. But they were paid cash. So they also had $10,000 more in cash that were provided to them. So more cash because they have more revenue. Those 2 accounts were affected by this transaction. The 6th event also happened on the 3rd of October, and it looks as though they had to pay their rent for the month of October. They paid, we usually assume the majority of expenses are paid in cash. There are some that are not, that we'll get into in the next chapter, but for the most part, when you see a company has an expense, they've paid it in cash. And so here, they have paid office rent, right, for the month. Well, they paid in cash, and so they have less cash. Cash account is affected, and they have much less cash. But expenses, which this would be a rent expense, expenses, right, take away from the profit. So the more expenses a company has, the less retained earnings it has. And that's how you have to view that side of the transaction, okay? Expenses take away from retained earnings because expenses basically, right, take away from the profit of the company. The next event, and we're, if you're keeping with us, we're already all the way on page 97. The next event happened on October the 4th, okay? And they paid, Sierra Corporation paid $600 for a 1-year insurance policy. Okay, so when you buy insurance, you don't use it up the same day you buy it. In this case, they bought it for a full year. And so they have more prepaid insurance. So the fact that they have more prepaid insurance is what's shown here. Again, when you are buying insurance, as much of anything else, you're using cash to do it. So you have less cash. Okay. Event number 8, ocho, happened on October the 5th. Again, notice how it's sequential by date. It's going to happen one transaction at a time, date by date. Sierra Corporation purchased 3 months of supplies on account. Now, when you buy something on account, that means that you were able to purchase whatever it is they purchased. In this case, they purchased a bunch of supplies, and they were given a bill to pay. So when you purchase something on account, it means that you're allowed to take the goods with you, and you got a bill to pay. Okay. So in this case, they had $2,500 worth of supplies that they received that they have to pay for later. So supplies are affected because $2,500 more of supplies just came into the company. But they have to pay for that later. Later meaning 30 days. It's a bill. And so now they have more accounts payable. They have more accounts payable. All right, we are moving on to page 98 now. Page 98. Event number 9 happened on October the 9th. In this case, they hired 4 employees to begin work next week. Well, when you hire an employee, do you pay them up front? So if you got hired, has anyone ever given you money up front when they hired you? I would say 100% of the time, the answer is no. Okay. If not 100%, 99.9, because there's, I guess, no 100%. So I would say 99.9% of the time, when you got hired for a job, they didn't pay you up front, no matter how much they promised to pay you. Whether it's $20 an hour or $1 million a year, no one gets written. You don't get that check up front because you never show up to work. You already got your money. And so I would say that this is not a transaction because when you hire someone, you don't pay anybody up front. So no transaction occurred here. Doesn't matter how many people you interview or how many people you hire on a particular day. It doesn't matter. You're not paying them up front. Accounting only records financial transactions that are happening as it happens. So just because you hired employees and you promised to pay them X amount of dollars doesn't mean you record it. You only record it when you actually pay them. Event number 10 happened on the 20th of October. And they paid a dividend. Now again, we are going to assume that these dividends are going to be paid in cash. Okay. So we have a $500 dividend. We have less cash. And look what happens. Dividends take away from retained earnings. Right? So more dividends means less retained earnings. So dividends basically look like that. We subtract dividends away from retained earnings on the retained earnings statement. Right, so it looks like the retained earnings statement. And the last event here, event number 11, now that the employees we hired worked for 2 weeks, and they now earned $4,000 of salary that we paid them on October 26th, that's a transaction. Okay, because we are paying, literally paying our employees. We're giving them a check. Okay? We're giving them cash because they work for us. So now it's a transaction. When we hired them, no. When we pay them, yes. Okay. So when you pay employees, that's a salaries and wages expense. Expenses take away from retained earnings. They take away from our profit. So more expenses mean less retained earnings, less profit. And of course, you and I get paid in cash. It's a beautiful thing. So the company had to use cash to pay the expense for the employee's payroll. Okay. So this is all wrapped as a summary of this, by the way, on page 99 in your book, showing all of these transactions together. But this is something that you have to know, The do it exercise, this particular exercise is on page 100 in your book. Okay. Excuse me. And here what they've done is they've actually given you the transactions. We kind of read them across. And they're asking you, what happened? What happened? I don't particularly care for this particular exercise, but it's the one that's in your book, so we'll do it. We'll review it. But you'll see the exercises that I'm going to be giving you for this are basically look very much like the Sierra Corporation exercises that we just went over. And this homework has to be done quickly. It has to be done by next class because that understanding has to be in place for you to do well on the next part of the chapter. So let's take a look at what happened in number one. It shows that we have more cash and we have more common stock. Now this is very typical. This is how corporations start. All corporations start with investors putting cash in the company and they receive shares of common stock. So this is a transaction you're going to see thousands of times if you study accounting. But you will see it hundreds of times in this class, guaranteed, okay? And so more cash and more common stock simply means that the company has sold shares of stock to investors in exchange for $25,000 in cash. So more common stock, more cash. Transaction number two shows that we have more equipment, but we also have more accounts payable. So obviously we bought equipment and we got a bill. We're going to pay for that equipment later. And so what happened here is the company purchased $7,000 of equipment on account. Remember, that little phrase is going to happen a lot in accounting. So you should probably know what this phrase means, that we bought something without paying for it now. We got a bill. That bill is due in 30 days. If it's due in 30 days, as you know, as most bills within 30 days are accounts payable. Number three, it looks like we have more cash, $8,000 more in cash, and $8,000 more in revenue. And so it looks like in this case, we received $8,000 in cash because we did work. Again, the word performed means it's done. Past tense, performed, done. It's already done. Delivered, ed, done. So in this case, we've already done the work, so we've earned it. That's why it's in revenue. Revenue is earned by selling products or services. And it looks like we got paid in cash, which is the preferred way to get paid. We really do want to get paid in cash. And here, the last piece here doesn't really, actually in your book, it actually has a little note on the right side indicating that this is rent. And that's just my scribble for rent. So for transaction number 4, we see we have less cash and we have less retained earnings because we paid a rent expense. Again, this note is in your book. It's not on the slide, but it's in your book. And so what happened in transaction number 4? We paid $850 cash for the rent. Okay, for the rent. So this is basically one of the most important things. I'm going to stop the slideshow and come back to our screen here to get questions.